Thank you, Stacy, for hosting me and having me here to come to speak. And thank you all for joining. Very excited about the topic tonight, 1031 exchanges. As Stacy shared, I am, let's see. I'm trying to get this clicker to work.
Works for me.
There we go. There we go. So I'm a financial planner, wealth management advisor, Twin Rivers Wealth Management. We're a fee-only RIA firm. A little bit about myself personally. I've been working as an advisor since 2014, and I was asked by Carol, like, well, how did you even break into that industry? And really, it started, it was inspired by the work that I'd done as a Medicare insurance specialist. You know, I'd get these heartbreaking calls from clients who I had assisted. They weren't able to afford their retirement. And one of the things that I came to realize is that you can be poor at any income level. You know, some of these were very successful individuals. They didn't have a plan to manage their wealth. And that's what I love doing. I love partnering with the families that I work with to make sure that we're being prudent and not only preparing for their longevity and their future, but successive generations as well. Father of four. Yes, I drive a minivan. We are expecting our 5th in November. And on weekends, you can find me making pizza, my uni pizza. I love pizza. So if any of you like pizza and you have a pizza question, hit me up anytime. Got recipes for you all day long. Yeah, I'm a CFP, accredited portfolio management advisor, and behavioral financial advisor. So a little bit about myself. You know, as far as our presentation tonight, you know, one of the things that's really important to me is make sure that I'm providing good value to all of you. So if you have questions as I'm going through some of this content, feel free to ask away. Those of you who are joining us via Zoom, you are included. So just unmute yourself and go ahead and ask away. So for tonight, we're going to be going through a case study, and this is based upon a real client case. And we're going to, through this case study, we're going to look at all the different aspects and different components of a 1031 exchange. And in this particular case, it made sense for the client to use a DST. Now, Stacy kind of stole my thunder. I was going to ask how many of you are familiar with 1031 exchanges and whatnot. It seems like a lot of you are. How many of you have heard of a DST, a Delaware Statutory Trust? So 1, 2, 3, 4. Okay, so a lot less familiarity with that. So really excited to cover, you know, this option with you all tonight. We're going to be going through the tax treatment of, you know, if we do sell a property without considering a 1031 exchange, we're going to cover that, you know, briefly, the 1031 exchange process, and some of the different, you know, Delaware statutory trust strategies, you know, which are available. So anyhow, so diving into it here, you know, my goal is to really help demonstrate the different considerations when we're thinking about the strategy. And I'm not going to be covering any specific DST. This is not a product sale. Right? This is really just a case study. I'm not a CPA. I'm not an attorney, so I'm not giving tax advice or legal advice. Twin Rivers Wealth Management, we have an awesome tax, you know, portion of our firm. And so whenever I'm working with clients on a 1031 exchange, we're always including them in the conversation, making sure we're covering all the different components and tax considerations. If you're doing a 1031 exchange, make sure you're working with a great tax professional. You can make sure that it goes smoothly and that you know, you don't incur any boot or that we hit all the various boxes that we need to check. So with that, let's dive into it here. So initially starting out here, this is kind of the client profile. So this is really going to set the stage for us tonight as far as, you know, the overall case and the overall situation. This client's name is Rick. I pulled Ricky Ricardo. There's great pictures of Ricky Ricardo. So he's an attorney, 63 when we first started this discussion process. He was previously married. He had investment assets between his, you know, taxable brokerage account and his retirement accounts of about $3 million. So he's done a really good job of saving and investing over his career. He has a moderate risk profile, so he's not super aggressive or super conservative. He's, you know, in the middle of the road. Now, here's where it starts to get really interesting. He has 2 rental properties, which he jointly owns with his ex-spouse, and we'll just say her name is Lucy. Now, between these 2 rental properties, they're combined values roughly $1 million. One was valued at roughly $600,000, and the remaining 400,000. So, but between the two of them, roughly $1 million. And they have 2 children, and their ages 24 and 20. They're mostly independent. The older child is married and she's financially well on her way, and the younger one is his son. He's still finishing up college, so every so often he will need some financial assistance. So I've been working with Rick for about 5 years, and every so often I'd be like, hey, how are those rental properties going? And up until this year, his answer has always been very positive. Well, come to find out, it's been primarily his ex-wife, Lucy, who's been doing a lot of the day-to-day management. Now, they do have a property manager, but in terms of decision-making, she's always taken the lead. Now, unfortunately, this year, he had a very rough rental year. There's a tree that fell on the roof of one of the rental properties. The insurance company refused to pay. There's a prolonged vacancy from that. And there's also disagreement about the other rental property because it had been below market rate for a period of time. And there's a disagreement between them as far as what to do. So I have a question. Has anyone experienced something unexpected when investing in real estate? Come on, we all have, right? And so really this particular year had really demonstrated to him, man, I don't know that I want to do this in my retirement, right? I'm getting really tired of this stuff. And so, we started talking more and more. And for me as a financial professional, my goal is really to, make sure that I'm taking the time to understand my clients' goals and really clarify what those goals are and think about, okay, well, with this particular investment, what long-term rate of return do we need? What level of income are we going to need to take from this investment in order for you to, achieve your long-term goals and be financially secure, right? So we had a number of meetings about this, and every meeting I would check in with him on it. And so over these meetings, we were able to clarify these goals, and clarifying these goals really helped in the whole process because there were certain points where we kind of hit a sticking point. And I was able to redirect him back to what he expressed his goals are, and it helped, progress on the overall transition of, these rental properties. So leading up to his retirement, he realized, hey, I need to be financially completely independent from my ex-spouse, Lucy, right? I want to have full autonomy, full control of the investments that are mine. Now, so really what brought this up was just the amount of conflict that they experienced in that particular year. Up until that point in time, it had been sunshine and rainbows because, again, she was taking the lead on most of the management and decisions surrounding the property. He did not want to be involved in any decisions. He did not want to have to call the property manager, didn't want to have to approve the price for a toilet or whatever it may be. And he also, leading up to his retirement, he had a lot of anxiety about cash flows. So he did not like the fact that he could have a substantial deviation in income and expenses when it comes to these portions of his assets. Now, he is an estate planner. And so he also had in his mind, okay, when I pass, my half will pass on to my 2 children. The challenging part there is now they're going to be co-owners with his ex-wife, Lucy. And there's a contentious relationship between his youngest and his ex-wife. So he knew from an estate planning and a legacy standpoint, that's probably not a good thing to have, right? Within this transition, he wanted to be as tax efficient as possible. This guy does not like paying taxes like any of us. He wanted to maintain his real estate exposure, but he also realized, hey, it might be a good idea between all of his real estate assets to diversify the type of real estate that I'm invested in. Okay, so I'm going to pause here. So far, so good. All right, so his initial concept, I'm done. I just want to pay the taxes and call it a day. Rick, You sure you want to do that? We could absolutely do it. You could afford to pay the taxes, but you're gonna be leaving a lot of money on the table. He's like, yes, I have my mind made up. This is exactly what I want to do. I'm like, okay, time out, Rick. I'm gonna go to our tax team. I'm gonna have them run a tax analysis so we can get an idea of what your overall tax exposure on this is going to be. And I see some of you shaking your head. You know, it's going to be expensive. So I was explaining to him, well, when we look at, you know, rental properties, there's a couple different components which are involved with it. There's the, you know, basis, the original purchase price of the property. There's capital gains, which we experience from the appreciation of that property. There's also a recapture of depreciation. So when we hold real estate assets every single year, we're required to gradually depreciate that asset. And I was explaining to him, this recapture of depreciation is taxed at ordinary income tax rates up to 25%. And that's on a federal level. This is not including state income taxes from this transaction as well. So met with the CPA, had the tax team generate the analysis, and this was us. This is Rick, and this was me. So upon, yes, this is based on a real client, real client, real case study.
Okay, so did he really make that face?
It was close to that. I had my arm around him and a box of tissues in the other, right? No, but it really surprised him to see the overall negative tax impact. I mean, his share of the 500 of the million would be 500,000, and close to 100,000 of that would go to taxes. Ouch. Right? And so I kept telling him, you may want to consider a 1031 exchange. And so now that concept seemed a lot better to Rick. So he still had the resistance of, I don't want to be a landlord. Like, okay, I understand that, Rick. You worked really hard, you saved really well. One of the things I was impressing to him is, you know, you've invested really well. You have your taxable brokerage account and your retirement accounts. Odds are you're not going to need to tap into any of these assets, which are held in real estate. And he's like, gradually came to understand that. And so I started explaining to him the 1031 exchange process and what that looks like. Now, you know, I'll go through this pretty quickly. It seems like a lot of you are very familiar with 1031 exchanges. But you know, there's a couple key points in here, which is super important. You know, point number one, if you are planning on doing a 1031 exchange, you never want to take possession of the money. You just blew it up, right? So step one is to work with your real estate agent, you know, have them help you select what's called a qualified intermediary. This is where the funds are going to be wired and held until you're able to complete the 1031 exchange process, right? So once we've identified the QI, then we have roughly 45 days to identify the potential replacement property. After that timeline is met, then we have 180 days to close on the new property. So those are roughly the timelines that we're working with. And in situations where there's, you know, low inventory, for example, this can be a little bit of a stressful process, right? So, you know, the good news is if we do this right, the tax basis will transfer and we won't incur, you know, capital gains taxes upon the transaction. Now, if, you know, there are considerations in regards to loan to value, right? And so if we're going up in the loan to value ratio, that's okay. If we're going down in the loan to value ratio, we may end up actually incurring some boot, which is, you know, basically taxes that are due upon the transaction. So you can go up in leverage and not down. Go ahead.
Can this money be invested into an existing property which has?
So like an existing property that you already hold, or I'm not sure that I
No.
understand the question. Yeah. Okay. So the answer is
What, I never thought about that.
yeah.
Good question.
So basically what you're saying is, if you're selling one property, you're looking to roll the proceeds into an existing property rental property that you already hold. Yeah. So that'd be no.
Can you do a wash sale? of an
You're,
existing
you're,
property?
so like selling one property at a loss and selling another property at a gain?
Yeah, so the one of the property, you're making a profit, the other property, you have a huge loan on, but you can't directly invest. So you sell this property to your own company. And then buy this property within the 45 days. Whatever. So,
You know, I don't know all the mechanics of how that would play out, so, but I mean, I'd be happy to connect you with our tax team and we can go through the specifics of your scenario and situation and figure out most tax efficient way.
But I
do
think
that.
not, because it's all your taxes and it's a
Right.
federal tax thing, so if the ownership's already connected to you, I think you should ask the income.
Right,
Yeah.
yeah, it's gonna get really complicated really quickly. Yeah, anyhow.
Good question.
Yeah, great question. Okay, so we went through the 1031 exchanges, like, okay, I'll consider this. What are some of the investment options which we would be investing into? And this is where DSTs, which stands for Delaware Statutory Trusts, come into play. Really, there's two different types, and for our case scenario today, I'm going to focus more on DSTs that have a finite existence, a finite period of time. These are typically 7 to 10 years. And there's other DST options which transition into a REIT, which is called a 721 exchange, and there's an UPREIT, and that has more of a perpetual continuation. And there's some additional liquidity considerations that come with that, but in his particular case, we did not need that additional liquidity. So if you're in a situation where you do want to do a 1031 exchange and you do want to consider something a bit more passive, know that there are different options out there. And really what would be helpful in that situation is getting clarity as far as, okay, how am I going to create my retirement income? What are my sources of liquidity? And how am I going to meet all the potential future obligations that I have? But in his specific case, really these assets were set aside for his children. He didn't have a current need to dip into the principal of these assets. Now, one of the great things about DSTs is that there's different types of real estate which we could invest in, right? So it's not limited to residential real estate. There are residential real estate DSTs, but in his particular case, we ended up investing in a senior living facility and a distribution warehouse, right? Do you guys know those like huge Amazon distribution buildings? Invested in one of those. So there's medical buildings, there's student housing, there's self-storage, and each of these have slightly different profiles. So a slightly different level of income, a slightly different level of appreciation potential. And so as we started to comb through some of these different options, really having that clarity on the level of income that he needed versus the long-term appreciation potential is really helpful in narrowing down which combination would make the most sense for him. Now, with these DSTs, he had these two properties. We ended up doing an exchange into two different DSTs. He could have done one big DST. He could have done 5 different DSTs. Now, because there's a finite life to these DSTs, finite period of time, 7 to 10 years, I didn't want to overcomplicate the situation and have 5 different DSTs, which have potentially 5 different periods of time in which they'd be liquidating, right? So in his particular case, we did want some diversification, but we kept it down to 2. Now, there's also different locations that these buildings are in. One is in Illinois and the other is in Florida, right? So not only are you getting diversification in the property profile, the building type, but you're also getting diversification in location, which can be very helpful. So if you're looking for more growth, the ability to invest in an area with high growth potential over the long term, increases your odds of achieving the long-term return that you want. Go ahead.
Question, Ricky's a young man, 64, considered young.
Yes.
So you say these have a finite length of 7 to 10 years.
Yes.
There's a good chance he'll be alive. in
Yep,
7 to 10
absolutely.
years. So what happens when they mature?
Super great question. I'm glad you asked. So within that period of time, he'll receive notifications like coming up to when there's the expected liquidation date. The sponsoring company will say, hey, Ricky, good news, we found a seller for the property. Here's when we're expected to close. What would you like to do? Would you like to invest into another DST? Or would you like to take your cash and pay the capital gains taxes? So he has choice.
Or he can buy his own real estate.
Exactly, right? If you want to get back into residential real estate and do that again, you absolutely could.
So does that take another 1031 exchange then?
If he's not taking receipt of the cash and taking that money to the bank, then yes, that would be another 1031 exchange.
You go from one DST to another or to property?
Yep.
Take another 1031 at that point?
Yep. And so, timing wise, one of the beautiful things about these DSTs is these sponsoring companies will typically have multiple different DSTs going at once, right? And so when that time comes, we don't know exactly what investment options are going to be available, but he's going to have a choice of multiple different DSTs. Whereas if you're trying to do, 1031 into, a rental property or a fourplex, there may or may not be availability, and there's that rush to close on the, transaction within that, 45 and 100 day window period of time. Yeah. Great question. Any other questions? Yeah.
Yeah, identification period down. Did it used to be 90, or am I just making up stuff in my mind? It's always 45.
I don't know the history of it.
Yeah.
I confirmed the data, so identification period is 25 days. Yeah.
Short, but.
Yeah, totally. It's not a ton of time. Yeah.
It hasn't recently changed, but.
Yeah.
Down to the water.
Yeah.
Do you have to commit to a Delaware statutory trust for 1031 or?
So within, yes, super great question. And I will circle back to you to confirm this, but I believe within the identification period, you can identify multiple properties, right? And if one of the properties ends up not proceeding forward, no harm, no foul, as long as the assets are being invested and, it continues forward, right? So could there potentially be a situation where you're trying to do a 1031 exchange and buy another investment property and also kind of have this as a backup? Yeah, potentially. But in terms of the identification, process, the qualified intermediary would be able to give you good guidance on that. And we'd also ask the tax team. But when I was going through this process with Rick, one of the things I do remember is like there was uncertainty as far as which DST he wanted to go into, and there's a new DST that was becoming available. And so one piece of advice that we received from the sponsoring DST company is like, well, you can actually identify multiple, and whichever one you finalize to go with, we can proceed forward and it won't impact the overall 1031. Yeah.
I thought when I did my last 1031, I identified 3.
Right. There's a specific number. Yeah.
You have to make one of them work.
Right. Yep.
How does depreciation work on this the same way?
Right. So another great question. So the depreciation, schedule, continues. There's not a difference there.
It resets though when you.
So the cost basis of, so let's say, in this particular case, Rick had owned these 2 rental properties with his spouse for, a long period of time. So they had a very low basis. That low basis continues forward with these DSTs that he now holds, right? So it's not like you're eliminating your depreciation or your recapture depreciation or your capital gains, right? You're still going to incur that.
We'll have to pay state tax in Illinois.
So another great question. Yes, the answer is yes. It's funny. I was helping him out, and we met with the tax team this year. He owed like $6 in state income taxes. So that
It
is
must not have done very well.
Well, no, I mean, he had deductions and like the overall level of income, from that state, was, pretty low. But I mean, as far as, the overall rents, from these various properties, we went through like a various combination, right? And so one of the things that was very appealing to him about the distribution warehouse is that Amazon is the one that's leasing it, right? So it's super secure. The coupon, I know it's a little bit hard to read. So the cash flow from that is, 3.4%. So you're not hitting grand slams in terms of cash flow. But the security of having Amazon as a tenant is very secure, and there's also some potential for appreciation. Now we looked at student housing, right, and there is some debt on that, in addition to the cash flow being higher, right? So the cash flow for the student housing was 4%, and with each of these different DST options, they had different lease agreements. So with Amazon, I believe it's a 10-year lease with like 1.5 or 2% increases annually. With the student housing, it was a different structure. Right. And so since he's held these, DSTs, we've gradually seen the income on these DSTs, gradually go up. So, in terms of like the overall, complexity of your tax situation, if you have 4 or 5 of these, yeah, you could absolutely be filing state income taxes in 4 or 5 different states. The other thing that we looked at in addition to student housing was the Chicago healthcare. They have this titled as Chicago MOB DST, and that stands for Medical Office Building. No, it's not associated with the mafia or the mob. So again, in that particular case, is paying 3.5%. That particular one didn't have any leverage on it, and he ended up going with this combination, which was the distribution warehouse and the senior living facility. There's some leverage on this, and it was 4.75%. So every single month, he's receiving, checks from both of those entities, and he's just really happy that he's not seeing a ton of variability in his income. It's reliable, it's consistent, it's every month. He's not being pulled into any day-to-day management decisions. So he's happy as a clam. All right, so now let's get into, go ahead.
Good question.
Yeah.
So what does the appreciation usually look like? And
Yeah.
how is that divided among investors?
Yeah, super great question. So, in terms of appreciation potential, it's going to be different based upon, the profiles of what you're investing in. So if you look at, Amazon's, distribution warehouse, the amount of appreciation that you're going to see in that is going to be limited compared to something like senior living, right? So with senior living, you have a lot of consumer demand for, those, the type of care. And so you're going to gradually see rents for that go up, which is going to increase the overall long-term value of the building. So in this particular case, I took Rick through the historical track records of the different, profiles, which is again, kind of how we narrowed down this specific combination. Yeah.
A lot of these DSTs, are they also, well, back up. The general partnerships and limited partnerships that you can invest in, do those usually have a DST arm or?
I don't know.
Yeah.
I don't know. I mean, like when you say general partnerships and limited partnerships, like,
Yeah,
is this in regards to,
maybe like an apartment building, like
okay,
they want to bring a bunch of people in
Sure.
and buy the apartment building,
Well, a
Minimum
DST is like a
25.
formalized version of one of those.
25 to 100,000.
Yeah, well, I see the DST as being like a formal version of one of those where they actually they've gone through the securities, so they don't have to
Oh,
limit it to 10 investors or less.
right?
It's a lot more formal, so it's almost like is it a security?
Yeah, I mean, it's a security.
Mhm.
They have to go through some steps to get set up as a DST.
Mhm.
Yes,
Is that like a syndication where?
Oh, that's what
Yeah.
sure.
Where the investors usually have to split up only like 75% of the equity at the end. And the partners, whoever put it together, they get the first 20 to 30%.
Sure. I mean, yeah, that's a great question, and it's probably gonna vary, between the different types of DSTs that are out there. I mean, if you go back in time, there's like this DST that was advertising on the radio, and it's like, they're advertising, investing in Taco Bell locations, right? And if like you looked at some of their fee schedule, like a very high fee schedule. Whereas, the particular DSTs that I use, they're, some of the largest in the industry. So, as far as like their overall structure, they do have some of their own money invested alongside with their investors, right? And that's kind of the way that they structure it. And there's an overall management fee, which is, assessed, on, the ongoing funds within it. And then if they perform at a certain level, usually there's an agreed upon hurdle rate. So there has to be a certain performance level. And if that's met, then the sponsoring investment company may keep a percentage of the overall performance.
So is this mostly DSTs, are they through like companies like Pasco and is there quite a few different companies that?
Right, yeah, there's a number of different companies which offer DSTs, right? And so some companies will only offer like, these, finite, start to finish, we're looking at 7 to 10 years, and others offer, finite in addition to the 721 with the AVID, right? So there's gonna be a variety of different offerings.
Are these actual numbers
These are numbers, yeah.
and are,
This is ballpark, yes.
okay, so is this after the management fees are paid?
So yes, the yields or the cash flow, that's after everything is paid,
Money in the bank?
money in the bank. This is, yep, exactly. This is cash that is coming to his mailbox via check.
Which is 4.21%.
Yeah, this one is 4.75.
So essentially, if they didn't have any appreciation, be smarter to buy bonds.
Well, so we placed this DST a couple years ago, right? And interest rates were lower then. If you're looking at, the 1-year treasury right now, yeah, it's paying in the low fives, right? And you have complete liquidity, guaranteed of, principal and security. Now, since this has been placed, this was the starting, cash on cash return. So since, initiating these DSTs, there's been increases in rent. So if we were to look at these numbers today, it would be higher, right? Plus you have the appreciation potential of the property which you're investing in, right? Which you're not going to necessarily find nearly as much appreciation in bonds.
Well, you can't. 1031.
Right, exactly. Yep. Yep.
You don't want to do some adjustment factors.
Sure.
Close to 100,000.
Investment if you get it.
Yeah.
Right. I mean, in his particular case, I mean, if we didn't do a 1031, then, 20% of the value would have just gone to the IRS, right? And so in his particular case, he wanted to keep some of it conservative. So could one might make the argument that the industrial portion of his portfolio, is that very similar to a bond profile? Absolutely. But that made sense for him. That's what he wanted.
When I did my last 1031, by transferring different properties, I had some leftover amount which would be moved.
Food.
And I ended up using a DST for a small part of it
Yep.
to get rid of that problem.
Yep.
However, the DST I am in is terrible returns compared to
Shoot.
the properties that I 1031 into. So
Yeah.
You
Using,
divide it up into multiple, and that's what apparently doesn't do.
Yeah.
There
Yeah.
a limit, how much they can get?
so we had a client case last year. He sold a big commercial building and he 1031 into 10 different DSTs. So, I mean, and you touched on the point that is spot on, like in terms of evaluating which DST company to work with, you definitely want to look at assets under management, their long-term track record, the overall costs associated with the DST, like all those are very important contributing factors to the long-term performance of it. So, doing that due diligence up front is super important with these.
what kind of returns have you seen on DSTs?
So I mean, again, there's different property profile types. So I was on the phone with the same company earlier today, and they invested in student housing. It was a particular property in Tennessee in 2015, and their long-term return, when they just liquidated that positioning, was like 126%, right? So student housing is going to have a different profile relative to the distribution warehouse, right? So like getting clarity on the income that you need today versus, the long-term appreciation potential, how much debt or the overall loan to value ratio that you're comfortable with, is an important part of, the mix in the equation. Yeah.
Let's say we're putting together a small syndication.
Sure.
10 investors. Can one of those investors be invest their 1031 into that project?
So you're,
Yes,
Thank you.
After your 1031 is completed, you purchased your new property.
Yep.
Do you have to wait a certain amount of time to pull some cash out of that?
So you bring up a super important topic, and I'm glad that you did. So with these DSTs, if you look at, a residential property, a fourplex, if you have equity in it, you can do a cash out refi, right? With this DST, the money's tied up, right? So you get, your rents to, in your mailbox every month, but you're not going to be able to tap into that, right? Questions? All right, should we move on to some of the state planning considerations? So, Ricky is an estate planner by trade, right? So again, this is, top of mind for him, and he had a lot of questions, right? So what happens, after his death, and so he's, looking at, the original setup, you had the two residential properties as heirs, his two children would receive a step up in basis. If there's the outstanding debt, and this was very interesting. How many were here last month when we had the estate planner? Okay, so a good number of you. So one of the points that is it Todd?
Mhm.
Yeah, one of the points that Todd made is, when there's that change in ownership, if there's debt on the property, that loan could be called due, right? So there's certainly the potential to refinance and continue to maintain the property. But that, again, that loan can be called due. And there's also decisions that will need to be made by the heirs in terms of, do we maintain this property and continue to hold it? Or should we sell it? And there could absolutely be a disagreement. And again, in his particular case, there's a contentious relationship between his youngest and his ex-spouse, right? And so he realized that, it's not necessarily a great combination, for the betterment of everybody. So, there's also trust and, probate provisions, that would apply, with, owning those two single family homes. Now, with a DST, what happens here, right? So, the heirs, his two children, would receive ownership shares in the DSTs that he invested in, right? And so it would continue to operate. And once it reaches the end of, the life of the DST, of the 7 to 10 years, depending on when they end up inheriting it within that cycle, at that point, they'd be able to liquidate it and, either roll it into another 1031 exchange or take the cash. There's still the step up in basis, which occurs, right? So they still receive that tax benefit, but there could be a period of time in which they're waiting in order to gain the full, value of that particular asset. When there's leverage on a property, and in this particular case, there was the senior living facility. There was a loan on that. That loan applies to, the DST sponsoring company. And so, when there's a situation where there's debt, that debt would not have the potential of being called or need to be refinanced. Did I lose everybody?
A related question.
Yeah.
First of all, if they're maintaining percentage ownership independent of them,
Right.
they have
So-
to, right? I mean, there's, the DST is done when it's done.
Right, and so essentially what I was, trying to communicate by that point, right? So let's say Rick has 100 units in that senior living facility, right? And he's listed his 2 children as beneficiaries. Each of those would receive, quote unquote, 50 units or shares or whatever, however you want to designate that, right? And so they have full control and full autonomy of that. And so when it comes time, to either take their cash or invest in another 1031 exchange, they're not contentious with one another. Their decisions are fully independent of the respective person.
But that decision only comes to pass when that DST is completed.
Right, exactly. Yep. So that is one of the potential downsides is, let's say he passed away tomorrow, his kids would have to wait, another 6 or 8 years. Go ahead.
Like a secondary market for people that want to get out of these investment positions.
Yeah.
Sell at a discount.
Yeah, no, super great question. And I think it's gonna vary between the sponsoring DSTs and also where we are in the credit cycle. I think there's probably some DSTs who would buy the, ownership back at a discount.
Oh,
Yeah. So, but I mean, as far as like a secondary market for DSTs, maybe I haven't really seen it, but yeah, great question.
But if you buy with a 1031 exchange, that might be tough.
Right, exactly. Yeah. So, I have this, slide in here, which covers, the high level benefits. We touched on majority of these as we covered, Ricky's, case study. I think, some of the key things that really resonated the most with him is that he did not have to be involved in the management at all, right? He's completely passive, truly passive. He was also not exposed to any liability. As an estate planner, he's, that was one of his also big considerations. He did not want to have any tenants, any potential liability that someone's going to come back and sue him. And so those, in addition to, the estate planning benefits of this really helped propel that forward. It was kind of funny, at one point in our conversation and of this whole process, he's in negotiations with Lucy about, what she would accept if he wanted to sell his share to her. And he goes, Dom, there's negotiations, there's bitter negotiations, and there's negotiations with your ex-wife. So he ended up taking a little bit of a concession in terms of the amount that he wanted to sell these properties for to her. However, the ongoing rents he received on an ongoing basis was higher than what he was receiving previously. So I, took a step back. I'm like, hey, Rick, like, let's think about this in the big picture. Oh, by the way, the income you receive, even with this slightly lower amount than what we were hoping for, is more than you're receiving in rent now. He's like, you know what, you're right. Like, let's just get it done. And so anyhow, hopefully this case study was, helpful to you all. Yeah.
One question on that, what may include, does that mean that if I have $322,000 exactly, I can buy a DST with that exact?
Yes.
money?
Yes. Yep. So it's super helpful from that standpoint. All right, so I think some key takeaways as we're thinking about 1031 exchanges and whether or not a DST could or could not make sense. Just taking the time to outline and clearly clarify your investment objectives and like go through and rank them, right? So for him, having that current income was important. So like that was one of his top priorities. And so again, we were able to return to that and it really helped guide the overall selection and combination of the DSTs that we used. We also did, extensive financial planning together. So I was able to show him with clarity what his future cash flows look like and what his future expenses are and how we're going to meet those future expenses through, his investments and through these DSTs. So he was able to really visually see that. And again, that also helps steer how much we invested in the distribution warehouse versus the senior living facility. I think, big picture is like having a plan to enjoy the wealth that you've created is so important. I've seen cases and situations where people work super, super hard their entire life and, they hit retirement age and they can't slow down. They just don't slow down for themselves. Right. And it's like, no, you can afford to take that vacation. You can afford to go to Italy. Like, what are you waiting for? Just do it. Right. So in his particular case, one of the things that was clear in his mind, he didn't want to be involved in the management at all. So he didn't really have that challenge or that issue. But I've seen other cases where that is, an issue. And I really have to slow my clients down and tell them, hey, you need to spend some money and you need to go out and experience life and enjoy some of these things that you've put off doing. And lastly, make sure, that you're incorporating estate planning considerations with this, with this decision. So having a good tax team in your corner, having a good legal team in your corner, super helpful to make sure that we're investing the right way, and in alignment with your long-term objectives. So, with that, thank you. Hopefully it's helpful. I do have my business card here, so if you do have questions, and you want to go through your personal situation, I've got a little QR code that links directly to my calendar, so feel free to grab one. I'm always happy to help. I mean, even if it ends up not making sense and you still want to take some time to, kick the can and look at it, I'm always happy to help. So.
Now, will you go back one slide?
Yeah.
Please? Let's do another mini recap of your takeaways.
Sure.
AVID Investors, we have Dominik Anton here, financial planner with Two Rivers.
Recap.
AVID Investors,
Yes.
we have Dominik Anton here with Twin Rivers, who just gave us a great highlight presentation on DSTs.
Yes.
Give us the takeaways.
Okay, so a couple key takeaways. Having clarity on your long-term financial goals is super important. It's really going to help to guide the whole process in terms of where to invest, how to do it, how much should be invested in the various DST options that you have, and having that clarity of cash flows versus long-term appreciation potential. The other key thing is having a plan to enjoy the wealth that you've created. So, I've seen a lot of people where they work really hard and they don't make that transition. And unfortunately, I have to, slow people down and tell them, hey, we need to go out, spend some money, invest in the experiences that you've always want to have in your life, and transitioning your real estate investments to something a bit more passive is really helpful in being able to do that. And lastly, incorporating estate planning in the overall process is very important as well. So having a good tax team, having a good legal team, reviewing everything and working, as a team is really important to make sure we pull it off correctly.
What I also heard was that if you're considering a 1031 exchange, you are already after cash flow and tax efficiency, where you're swapping till you're dropping in a tax deferring plan. But the DST, it sounds like, also gives you less involvement than you should have in your overall real estate portfolio, and a clean estate transfer to the inheriting kids. And with a 1031, since many of us, when participating in them, are wanting to avoid boot, there's things like we have to replace the debt or go up in debt. And a DST is a place you can put your money to avoid boot, either in conjunction with a standard real estate purchase from a partial exchange, or from the need, say, for more leverage. Because on the open market, there's finite number of opportunities. With DST, there's multiple options with various levels of the timing you may need, the debt you may need, or a flexible buy-in to use up the rest of the funds. But we have to remember it's not liquid. So unlike with your own portfolio, you can't just decide when to sell and time the market. It's going to have a predetermined lifespan. And it can serve as a backup if you identify it. If your other deal falls through, you can identify a DST and then still have a successful 1031.
Yep.
So all great information here, Dom. Thank you so much.
Yeah, thank you.
AVID Investors, thank you so much. We're still available for questions.
Yeah, thank you, Stacy.